I mean, do you feel like you have a good grasp of the U.S. economy right now?
I actually think so. What's a little bit tricky is sometimes when you look at the economic data, you get conflicting messages. And we even saw that today in the ISM manufacturing PMI. Of course, the headline index ticked down just a little bit. Almost all of that was attributable to destocking of inventories. If you look at the employment sub-index, if you look at the new order sub-index, orders for export, consumers' inventories, customers' inventories, all of it pointed to relatively more demand, increased relative production demand for labor. So some of the fundamentals are actually relatively strong within the ISM picture. Pulling apart some of these conflicting messages can be difficult sometimes, but all told, we're in a relatively high productivity, high growth period, and it's difficult to say that rates are especially restrictive. What's going to be difficult in the year ahead is understanding the labor market, but all things considered, we still expect to see a relatively low unemployment rate and reasonably robust hiring.
Okay, so we're going to get those numbers on Friday, and we're going to get some JOLTS data later this week too. We're going to get to that in just a second, but I kind of want to go off script here a little bit, and just because we spent the focus of our program talking about what happened over the weekend in Venezuela. You cover economics for U.S. and Canada for Bloomberg Economics. Does this have an economic impact in your world?
Very little. Sam Stovall brought up an interesting point. He, of course, is the chief investment strategist for CFRA. You had him on earlier in the program. And yes, if we were to see a lot of additional oil supply come online from Venezuela to such an extent that it ends up bringing down energy prices by, let's say, $10 a barrel down to about $50 a barrel.
That would be a huge decline.
That would be a huge decline in oil prices, and it would bring down headline inflation about 50 basis points. Okay, so that gets us just incrementally closer to the Fed's 2% target, but still not all the way there. And given the fact that the Fed still focuses more on core inflation, and given the fact that any sort of decline in energy prices would open up consumers' wallets for more spending on other goods and services in the core, you can't really read through a decline in energy prices and discern anything about the Fed's reaction function, for example. So even if we were to see that supply come online, it doesn't change the U.S. inflation or rates picture all that much. And all things considered, it's going to be really difficult to stand up additional production in Venezuela right now. And it's going to be really difficult to bring that, let's say, 1.5 million barrels per day of additional production and exports online. And when that's the case, I'm really just having a difficult time reading anything from the Maduro expulsion, I guess we could say, to the broader macroeconomic landscape.
Is it more likely that we've talked so much in 2025 last year about power prices, right, for individuals, how that's tough on individual kind of economic pictures, if you will. But is that more likely to be inflationary pressures again in 2026?
Yeah, global natural gas prices, demand for gas liquids, demand for electricity and power, yes, is going to matter more than, let's say, gasoline prices. I think that's definitely the case. And so I do keep an eye on natural gas reserves, including in Europe, natural gas production here in the United States, exports through the Gulf. And I think that you're right, that power prices are going to matter a lot more than oil and gasoline prices.
Okay, let's get to some of the other economic data that we are set to get later this week. Okay, Thursday we'll get jobless claims. Before that, we'll get JOLTS and durable goods. We'll get December payrolls. That'll happen on Friday. We'll get housing starts and some data from UMich as well on Fridays. Payrolls, certainly, if I were to look at this that we have up on the screen right now, I think that's probably the most important thing.
Definitely. And look,
is it going to be good data?
In terms of whether it's going to be high quality data, it's going to be higher quality data. Whether it's good data, I guess it's in the eye of the beholder. So when we sharpen our pencils, we get an estimate of about 80,000 jobs added in the month of December.
That's lower than the forecast by analysts surveyed by Bloomberg.
But it's still about 20.
Sorry, that's higher.
It is higher.
That's higher.
It is higher, and it's about twice as high as the estimated break-even pace of hiring. That's the pace needed to maintain a steady unemployment rate currently at 4.5%.
Yeah, 65K is right now what analysts surveyed by Bloomberg.
What's the break-even number?
The break-even is about 40,000, 35 to 40,000. So we're about 2 times higher than that break-even pace. But here's sort of the wrinkle in all of it, is that we expect that the Trump administration's more onerous work requirements for folks on welfare and collecting transfers, we expect that those are starting to encourage Americans to enter the labor force once again. So even though in the broad scheme of things, an 80,000 print for NFP would be really strong, we think that this could be one of those months where even though we have a strong NFP print, we could also see an uptick in the unemployment rate.
Because there's the pool of workers,
exactly,
right?
Because if you have more people entering the labor force, you have an increased supply of labor, and more people looking for work, higher unemployment rate.
But the people looking for work, are the jobs out there for those who are looking for work?
It does look that way. Now, this is a bit stale, the data that we're going to get on Wednesday. We're going to get the November job openings and labor turnover survey. We're expecting to see, or I estimate that we're going to see 7.7 million job openings. That's a slight uptick from about 7.6 million job openings in the month of October. This is what's a little bit tricky, Carol, is that it looks like the industries that are creating new job openings also have some of the highest layoff rates. So it looks as though there's some churn in the labor market that's coming from the employer side rather than the worker side. If we were to roll back the clock about 2 years, we saw a lot of churn in the labor market. That was folks quitting their job and looking for new employment at higher wages. Now we see that churn coming from the employer side, not the employee side. When it comes from the employer side, is because they're trying to lower their labor costs. They're trying to lay people off, list those jobs again at lower wages. So
they have the upper hand right now.
So employers have the upper hand right now. And what it sort of means to me is that even though we could see an uptick in hiring, we see an uptick in job openings, real wage growth is facing a little bit of headwinds. And so it's not necessarily the case that we're going to have a perfect Goldilocks scenario. When we see those real wage pressures fading, it opens up a little bit of risk towards the end of this year.
I think about, just the last 30 seconds we have with you, the elections coming up in November, the affordability challenges that many Americans are facing right now and how that manifests politically. How do you think about that?
I think that it's going to be really tough for the Republican Party in the House races all this year. I think that the Senate's on a little bit firmer footing, but that's going to be the big research project for us in Bloomberg Economics, is identifying the disparate effects of trade policy, really, on different pockets of the country. The thing to remember is always that trade policy and tariffs has disparate impacts. It has very concentrated benefits, but it has very pervasive and widespread costs. The question is going to be whether or not the political ramifications of trade policy are going to really end up mattering for the House and Senate races. I think it probably will.